Hey everybody, welcome back to We Talk Money. This is episode 74, I believe.
Wow.
Yeah, we've been doing this for a little bit of time. Guys, the markets are a little bit quiet over the past week, so what we're going to do is we have a couple of topics that we want to do a deep dive on, like the mental game of trading and investing, talk about inflation, talk about volatility, and then we've got several questions for you guys before we jump in. Nick, you want to thank our sponsor, Y Charts?
Yes, thanks to White Charts. Our friends at White Charts, basically, this is a platform that you can use for all your fundamental research. My favorite tool as a retail and an individual investor is the stock screener. It's very powerful, and you should check it out. Go to whitecharts.com to get a free trial, or tell them that We Talk Money sent you. You can get 15% off your first subscription.
Awesome. With that said, let's jump into some charts, some news, some questions. Where do you guys want to start?
Well, it's funny that you mentioned that the markets have been quiet because they certainly haven't been quiet over in stock land.
No, not
Very true. I guess I'm just kind of bored with Bitcoin's price, so therefore everything's boring. But yeah, no, you're absolutely right. Things have been going crazy over there.
Yeah.
A lot of volatility.
So
What's
many
happening?
stocks.
Yeah, I mean, look, we had a mega cap like Facebook down around 25% over the past week on their earnings results.
And still falling.
Still falling. We
Last
had
I looked.
the craziest move in Snapchat on the back of the Facebook thing, which was so fascinating because Snapchat was down 25% after hours after Facebook reported and had some weak guidance. And so the market was basically saying, we think Snapchat is going to miss their earnings the following day. And the stock was down before they'd even reported earnings.
Yep.
Then Snapchat delivered, less than fear, or better than feared better than feared earnings. And the stock was up over 50% the next day, bouncing back massively. It was just crazy.
That was
to see.
actually hilarious to see how the market priced in an earnings miss in all the social media stocks.
Mm-hmm.
And to see what happened the next day, it just goes to show you that, like, nobody freaking knows anything. Everyone's just following the herd is going to get you in trouble. Like, if
Absolutely.
with Snap, if you followed the herd and sold your Snap position because of what happened with Facebook, like, you have to compartmentalize all of these different companies because they're all doing different things, and, following the herd gets you in trouble.
Yeah.
It's pretty wild to see with so many different people following, so many investors invested in the mega cap techs like Facebook, you can still get these massive moves. I think, it was like $250 billion of market cap just evaporated from Facebook.
It's stunning. And then Amazon did the opposite. And
Yeah.
they added the biggest addition, right?
Yeah,
in
Amazon was
market
up,
cap.
10 or 12% on their earnings last week. So it's we've seen some big moves. We expected this going into earnings season. We said it was going to be critical earnings season specifically for big tech.
I said that it was going to be the earnings season of gaps on the charts. Like, we are going to see some serious gaps in price. And it's going to be interesting going forward because a lot of the companies reporting now are kind of like, big tech's over. So, still some large companies, but more so the smaller names that maybe aren't so followed. And some of those charts are like the worst beat down charts. And so that's why I think gap season is what I'm calling it, because I think that's what we're going to see.
So for anybody that hasn't been paying like super close attention to earnings season, what's the general theme? Is everybody beating, missing? Is it a mixed bag? What's happening right now?
I think we've had something like 75 or 80% of the S&P 500 by market cap has already reported. It might even actually be slightly higher than that as of today. And something like 70 or 75% of companies have beat their earnings estimates for the quarter. Now, that's pretty typical. We usually see about a 70 to 80% beat rate because companies, they set their guidance to be beatable. And then, of course, sell-side analysts, they might set them a little higher in expectations of the beat. But typically, we do see a pretty high beat rate. This earnings season so far has not been different. Again, there's so much bifurcation among individual companies, right? Facebook getting crushed, PayPal getting crushed, and then companies like Amazon, Microsoft, and Google doing super, super well. And then, like Nikki said, we still got a ton of mid caps and small caps yet to report. But, from an overall perspective, looking at the largest companies, S&P 500 type of companies, it has been a relatively good overall earnings season. Going into this earnings season, we were really concerned if the big cap techs, have a bad earnings season and a majority of them miss, we could see the overall market down, 20% in a hurry. And then obviously a lot of stocks down way more than that. And so it was good to see that the majority of the big tech stocks, of course, excluding Facebook, have done pretty well with their earnings results. And that has helped the market rally off of what was looking like a, pretty ugly correction that we had just a couple of weeks ago. So it doesn't mean that the market won't have another correction or won't continue the correction at some point here in the spring, but it was very critical that these companies delivered on their earnings reports. And for the most part, 3 out of 4, let's say, have delivered. So
it looks like based on FactSet's data, this was on the 4th, over half of the companies in the S&P reported, and 76% reported EPS above estimates, earnings per share. So yeah, I mean that's basically
So the world
in line
is
with
not
the 5-year average.
coming to an end, huh?
It appears not.
Okay. I think one of the biggest fear news headlines that I've seen recently is obviously inflation, right? We've got more inflation data coming out later this week. I thought it was kind of interesting to see just kind of all the market sentiment around inflation. We talked about this last week about companies that do well in inflationary environments, companies that will suffer. And I was just kind of curious. So I tweeted out the other day, I said, where have you felt inflation the most in your day-to-day life? And we got a ton of really good answers. The biggest thing that I saw was food, obviously gas prices, oil's up, and this is something I thought it was kind of interesting when oil futures for a second, what was it, last year or 2020, when they actually went negative prices on oil futures. And Trav, you can talk about what happened with that and why that happened. Everybody was like laughing and saying, "Oh, oil's dead. We're beyond this." Oil's actually been the best inflation trade, or one of the best inflation trades of the past year or so. So Trav, for anybody that doesn't know or doesn't remember what happened, why did it go negative, and did it really go negative, or was that just a weird circumstance?
It was more of a weird circumstance. Oil only went negative, I believe, on the very first front month contract. Now, futures are kind of weird, right? Because you have to take physical delivery ultimately if you hold that contract through expiration. And so even though there's a lot of financial speculation with oil futures, there are real industry participants involved as well that are hedging, that are, either producers or users of crude oil that are in the futures markets. And the futures markets are physically settled in crude oil, meaning if you hold that, contract, let's say you had the April or May of 2020 contract and you were, long crude oil futures, at the end of that month when it expires, you've got to actually take delivery of those barrels of oil. Mm-hmm. So one of the reasons why oil went negative was that there was nowhere to store any oil at that time, because remember, we're in the depths of the pandemic at that point. There's all this excess oil because, people are inside their house not doing anything. Demand just plummeted. And so all these suppliers in the short run just had too much inventory of oil. And so there was just nowhere to store crude oil, or at least in specific areas of the country, there were no places, no available storage. So you couldn't, even if you bought oil for, $1 a barrel at that time, you had nowhere to store it. So you couldn't take delivery of it physically. So that's why some participants who were long oil futures that month, basically panicked and sold all of their futures down to prices that ended up being negative, because they were literally having to pay other people to take delivery of their crude oil. So a very interesting, strange situation. It was a little bit of a specific situation that was kind of a weird one specific to the way that futures work. But it also coincided with just a glut of oil inventory at the time relative to demand. And over the past year and a half, 2 years, the demand has recovered. Supply has actually gotten really tight. And so you've seen oil prices across the futures curve rise.
I think this is just a really good example of how there's these inflection points in markets where things get overly bearish, or unique situations cause prices to collapse and have some kind of reflexivity where they just compound, problems compound, and then prices go negative, or prices get to levels that just don't make sense on the downside or the upside. And so I'm constantly, as an investor, and I didn't pile into oil, by the way, right? Obviously hindsight's 2020, but these are the types of situations that I think are interesting. And that if you're an investor or a trader and you look for things like this, not necessarily weird futures contract situations, but situations in the real world where the markets just get overly bullish or overly bearish, that's typically when you can take the opposite side and have the biggest potential gains, right? It's the unpopular opinion trades that can really outperform kind of the trend riders in some cases.
Yeah, no, it's a great point. I mean, we've seen these are very interesting outlier situations like with the negative crude oil futures, but we've seen it in other markets. During the financial crisis, we saw, certain bond prices go to levels that didn't seem logically possible, like these basis trades that actually blew up some hedge funds where, theoretically certain types of bond spreads have to remain positive, right? I mean, another example might be, how sovereign yields went negative on a lot of government bonds over the past couple of years. Previously, if a decade or 2 or 3 ago, most people thought you couldn't have negative nominal yields in bonds, but that was proven incorrect. So yeah, there's really interesting situations right now in SPAC warrants. I've been seeing a ton of forced selling and warrants at prices that theoretically don't make sense to me. So I've been buying some, and It's been a painful trade so far, but got a win on one today, actually. XPOA, which is taking D-Wave Systems, one of the early pioneer companies in quantum computing. They announced a deal today. The XPOA warrants, I think I was buying all the way down from like 60 or 65 cents down to like 45 cents or so over the past month or two. And today they traded up to 80 plus cents. So that was a nice win, validated at least part of the thesis. But yeah, these things happen all the time. Forced selling, probably you could find examples of forced selling in markets, every couple of months in some place of the market.
Yeah, I mean, the same thing happens in Bitcoin too, where you can see on the futures exchanges, people get over leveraged, things get over bullish, and then you have a collapse, which causes mass liquidations. If those happen at the right moments of the market cycle, those are incredible buying opportunities, right? Not every liquidation event is a good buy opportunity, but when you have forced selling or you have situations that causes everybody to rush for the exit at the same time, that can create awesome buying opportunities. Okay, I have a question for you guys. I want to kind of kick this to you guys. Where have you guys felt inflation the most in your day-to-day life? I know we've talked about oil and food and stuff. Are there any other areas that kind of stick out for you guys?
Rent.
Well, rent where and under what circumstances?
In Austin, Texas. My God. Yeah, I mean, that's been pretty gnarly.
Yeah, I mean, people have been complaining on the Austin subreddit about, 10, 20% or more rent increases. And I mean, it makes sense. I mean, Austin's been the fastest growing city for a decade. But
what's hilarious about the whole thing is like when you do the math, and if you want to be in a certain area of Austin, it actually financially makes more sense to rent than to buy sometimes.
Yeah.
Unless you're planning on doing an Airbnb and, trying to cash flow it, or you're going to be in it for a really, really, really long time. But even then it can hurt, and rent just is so much cheaper. So depending on the location you're trying to get to. So rent is not always, it's kind of been demonized. Like if you rent, you're throwing away money, but in certain cities, that's not the case.
Yeah.
You take the difference and invest it,
I agree. My idea is like, if you're going to be in a city, it probably makes sense to rent, where if you're in a low property tax area of the US or anywhere in the world, and you can get a lot of value and you can get a lot of land for the same price. Like for example, in downtown Austin, a nice condo is basically $1 million plus, right? And I ran the math. I'm like, all right, say you put $1 million down, or say you just pay cash, $1 million for a small condo in Austin. After property taxes, insurance, and condo fees and everything else, on that $1 million place, you're still paying about $3,000 a month just in fees, where there's probably a building close by where you can get a 1 or a 2 bedroom for like $3,000 to $4,000 a month. And then you can take the difference and invest it. Like, you got to do the math in certain ways, but yeah, I agree. It does make sense to rent in a lot of situations in big cities.
I also think the grocery store has been a bit more painful. I definitely feel, I mean, I do all the grocery shopping, so like
I don't pay attention to food prices.
I know.
What have you noticed
but
that's
like
gone
a
up?
head of broccoli, like I think I paid like $4 for a head. It was $3.98 for a head of broccoli.
And what was it before?
I mean, and this could be where I was shopping. I was just at a regular grocery store, a regular supermarket. It wasn't a Whole Foods. It wasn't anything like that. But I mean, a head of broccoli should not be more than $1.50. I don't,
Okay.
I was actually just stunned. And grocery prices, that's something that's probably variable depending on where you're shopping and what location you're in and what you're buying. But I definitely feel like you don't get a lot at the grocery store these days.
Yeah. I did notice the other day that we were at a nice sushi restaurant, and a piece of bluefin tuna was $60, where I think it was less than half of that
That's
pre-pandemic.
ridiculous.
But granted, I don't even know if bluefin tuna is the most responsible thing to eat. Like it's you want to go for more responsibly
Sustainably
fished. There you go. I don't know. Trav, what about you? Have you noticed any inflation?
Yeah, I mean, early in the pandemic, I was trying to buy fitness equipment, and it was just insanely hard to find, and all the prices were jacked up. That has reversed itself recently, but yeah, things like gas prices, very obvious to see that at the pump, every week, the increases that have happened there. Looking at things like Airbnbs, I'm shocked by the level of prices at Airbnbs, and obviously that, it makes sense why people are returning to travel in droves, and
That's a good one.
yeah, supply is very, very tight. So
I miss the early days of Airbnb where you could actually get a better place for cheaper than hotels, but the secret's out. Everybody knows Airbnb now, and maybe that's, the increased demand. Supply hasn't been able to keep up with that, so that's maybe a driving force too.
Yeah, 100%.
And people want to be away from people because of COVID.
True.
So, I mean, it's crazy to see. We go skiing every year, and it's crazy to see how expensive it is to get a place in a ski village right now. Double. Prices are doubled easily.
Yeah.
Lift tickets up a lot too.
It's crazy.
Yeah, it's a wild world out there, and I think on the inflation side, there's still a lot to be worried about. You mentioned food prices. I think we mentioned this last week. ETFs of agricultural commodities are hitting multi-year highs. There's still actually some concerns out there that it could get really ugly with fertilizer prices. Natural gas did correct this week, but those prices have been up a lot, and those are feedstocks into lots of different crops, whether it's corn, soybeans, wheat, etc. So a lot of those crops have been showing strength, and there's some people out there that are worried about a severe increase in food prices, which could be destabilizing in certain areas, right? So that's something to keep an eye on.
We actually got a response to that question. This guy said, "I'm a farmer. Fertilizer prices are insane." So yeah, when you have prices of inputs that rise that early in the supply chain, that pushes everything higher further down.
Yep. Yeah, so those are still concerning. There's still indications that lots of parts of the supply chain are still very much in distress. And so I'm hoping that, some of that can get fixed over time. But, the Fed raising interest rates, might help to cool the economy a little bit, but it's not going to magically fix supply chains. And so that's, I think, something that's going to be interesting to watch over the next year is do any of these supply chain issues that have popped up since COVID, become structural and permanent, or can we actually address them and start to fix them? By the way, I'm still very concerned about inflation overall. I'm still watching bonds. I mean, we have seen the equity markets bounce a little bit over the past week or two, but, I'm still very concerned because equities have actually been diverging a little bit from credit. There's been some pretty ugly price action in fixed income over the past 2 weeks or so. We've seen even even investment grade, not just high yield bonds, but also investment grade bonds selling off as yields rise. We've seen European government debt, the yields have risen very, very rapidly, similar to what we saw in the U.S. government bond market over the past 6 months. We've seen a very, very rapid rise in bond yields as things reprice with the expectation of higher rates. Typically, what you would see when you see that quick of a move up in yields and pressure on bond prices, you can see stress in the financial system because of that. And so you'll typically see equities trade down when that happens. But, over the past 2 weeks, we've seen actually equities hold up pretty well. So, as we get closer to the CPI number that's coming out on Thursday, expected it might be like as high as
7.3.
Yeah,
it's expected to be higher than it was last sprint, which was 7%.
7.3% CPI in the U.S. potentially on Thursday. We'll see how that number comes out. Fed still hasn't raised rates, but now the probabilities of the Fed raising rates by not just 25 basis points, but up to 50 basis points at their next meeting in March, the probabilities have risen, I think, to around 40%.
Would they be so bold?
Well, the market thinks there's, almost a 50-50 chance now that will happen. I'm a little skeptical of that still, but, the Fed looks increasingly behind the curve on inflation.
You can pull up the inflation chart just to kind of demonstrate visually, like, how much it already has risen, and we're expecting it to go even higher. If you go back on the 5-year, 10-year time frame, it's like imagining inflation getting even higher from here is a stunning thought. when will it end? It's we expect this year for things to cool back off again, but
Later in the year, yeah.
right. But this is definitely affecting the consumer,
Yeah.
and that could put a damper on growth. And the markets. The markets are not trading with excitement right now. The markets are definitely, when you look at the price action, they're trading timid, and it could go either way. I feel
Yeah.
like right now in the broad market, the broad indices, the S&P and the Nasdaq, this could go. It's a 50-50.
Yeah,
For
I mean,
sure.
literally looking at the daily NASDAQ chart, I mean, we're below both moving averages. We've had a Fibonacci retracement to retest previous
The
support, now
200
turned
day.
resistance. So, yeah, I mean, even in Bitcoin, if we take a look at Bitcoin's daily chart, we're still in this massive, just range-bound trading action. Over the past few days, we saw a trend line snap, and we're back at the 45K price magnet. So yeah, same with Bitcoin. It's kind of a 50-50 area. Stocks obviously coming off of an epic rip. They're kind of mid-range, and that could also go either way. So this is kind of a grit your teeth, hold on to the seat, and hope for the best, I guess. I don't know. But I guess that's a question too that we can dive into around volatility, around uncertainty. How do you trade? How do you invest in market environments like this? Do you guys have a thought on how to approach 50-50 zones?
Yeah, I mean, I think, my overall, thought right now is to still remain cautious, but don't freak out, right? I mean, I think you can take advantage of environments like this, both on the downside and the upside. So, essentially buy dips and sell rips, as they say, really saving that dry powder for if you do get that, severe 15-20% fast correction in equities, because obviously a lot of stocks will be down even more than the indices, and we already have seen a lot of stocks down more than 50% over the past few months. So we've been dip buying on some of that stuff that we felt like got to really cheap levels that we could justify from a valuation perspective, while at the same time, being thoughtful about, keeping some dry powder, being a little bit more defensive, moving into more high quality positions. So it's really, for me, it's like, it's not about being all in or all out of the market based on, what I think it's going to do, some forecast of what I think it's going to do. It's just trying to, thoughtfully make sure that the portfolio is constructed and to be able to increase quality when you can on those huge dips, buy the stuff that you've been waiting to buy that has just been too expensive. And then when the market rips on these, 2-3 week rips, maybe you take some off the table, maybe you find some places to raise some excess cash in maybe some positions you're less confident in. And I think that's a generally pretty good way to go about it for a longer term focus, fundamental based investor.
Yeah.
Yeah, you can't get too, into the details too far. You'll have paralysis by analysis, and you won't, know what to do. And you have to remember, staying the course is part of the process with investing. I mean, they're like crypto investors understand there's ups and downs in crypto, right? You guys seem to understand that pretty well, and you seem to be able to trade that well. And stocks are no different. I don't know why I think people have just been spoiled with stocks because of monetary policy, because of low interest rates have definitely helped equities massively. And investors in stocks have just been spoiled over the past decade. But guess what? Like, this is actually more normal than you think in terms of, maybe not in terms of the growth stocks that have, gone up to crazy valuations and tanked 60% plus. That is a bit extreme, but we've seen this before. We've seen the 2000 tech bubble happen. We know it can happen, but you just have to remember that drawdowns and sell-offs are opportunities, and corrections are healthy for the market. I think long-term investors should be excited about the idea that the broad market could sell off more, and look at that as a huge wealth building opportunity.
I guess if that's true, if you have time, right? But if you're in retirement or knocking on retirement's
That's
door,
a different story.
that becomes a little bit more stressful, right? If you're facing the possibility that equities could fall by 50%.
But when you are in retirement, your portfolio is supposed to be constructed a different way completely.
True.
A 30-year-old is going to be in all equities. A 65-year-old is not going to be in all equities. But even so, like, bonds have been a tough spot to be recently, and that's kind of a challenging environment. But bonds were in a bull market for years, right? Like, And investors back in the day, they had a great run in bonds, but now that environment is definitely shifting, and there's some complexities there with someone closer to retirement and how to construct a portfolio, but they're not going to be in all of those equities. It's going to be completely different. So
Yeah, good point. And I think, it also depends on your timeline when it comes to like thinking about markets that are at 50-50 zones. Like with Bitcoin, for example, like in the short term, or Bitcoin or really any crypto, when I think of like actively trading it, I stay away from just choppy price action. Like I don't want to get in and just get chopped to pieces. I wait for the market environment to start proving to me that it's conducive for active trading.
boom. And I think right now, as an active trader myself, I'm looking at stocks and I have my foot on the brake right now. I'm not attempting to swing trade this environment. That would be silly of me. It's not time yet, but price action eventually will set up. And you can sense the shift in the environment and know when it's time to press the gas pedal with the trading.
Yep.
You can know that. It takes a little bit of practice, but it's very possible.
Good point. And this is a question that we got today that I think goes kind of hand in hand with what we're just talking about. Todd asks, in assets that go up and down, but in the end ultimately always go up, how can I be convinced to sell high and then hope to buy lower? I don't want to be a hodler, but every time I get that hot potato feeling in the short term, I zoom out and see the 5 to 10 year trajectory and don't want to pull the trigger. So basically, there's a balance, I think, between buying and holding and not getting shaken out of positions, and then buying and becoming a bag holder for stuff that has really, really deep drawdowns and either never comes back or takes many, many years to come back. So maybe there's a sweet spot there. I don't know. Do you guys have an answer for that or a way to think of that?
When I've actually seen this sentiment mentioned quite a few times in our community, because I think especially people who are newer to stocks, they'll come in and they'll look at a chart of, say, the NASDAQ or the S&P 500. And if you zoom out on like a, if you zoom out on like a 10, 20, 30 year time frame, I mean, it's like, wow, we're still like near all-time highs. Why would I buy this chart? It looks like it could be down 50% from here, no problem. But the thing that I think a lot of people don't fully understand is that, the earnings of the companies that underlie those indices have grown so much over those decades that, it is supported still by at least some level of earnings and growth in the economy. So while we may get to levels that are a little bit pricier, historically than they have been, it's very unlikely you'll see a 80% fall in stock markets, in developed markets. Not saying it can't happen ever, but certainly that is an expectation that's, I think, is very, very unlikely. I'd be curious to get your thoughts on how you view that on Bitcoin, though, because you can do the same thing. You can zoom out a decade and look at that chart and go, wow, that looks, pretty parabolic, I guess. And yet, you could have said that at any point in time over the past 6-7 years, bought it and done pretty well.
Yeah. I think you almost have to hold two kind of opposing beliefs or two opposing approaches at the same time. One is I have a lot of conviction in this as an asset class that it's going to grow over time, and I want to have a portion of that I never sell because of that thesis, right? And I just want to add to that anytime prices are depressed or oversold. The other is I want to be able to maximize the profit potential of that volatility and buy low, sell high, trade the trends, right? Or you could do one or the other. You don't have to do both. I've done well doing both, and I find that for me it helps having a portion of the portfolio that I know I'm never going to sell, and it also helps having a portion of the portfolio that when things get overextended, I can take profit and feel good about that. I can sleep at night and not have to worry about my entire portfolio going through an 80% drawdown. I just don't have the stomach for it. I want to take profit. I want to have cash that I can recycle and kind of use as a machine to grow my position sizes bigger and bigger and bigger over time, right?
I think that's key. I think that's such a great point. You have to think about those capital buckets, as you've called them before, like this person, maybe they're thinking about two completely different strategies for all of their capital. You've got to have that trading capital where you're trying to scale out, cash when you have the opportunity, and that long-term capital that you don't have to worry about the ups and downs. You don't have to worry if it's too high because you're just going to be holding that for a very long time, and it's very long-term focused.
Yeah.
So I think that just separate that thought and those capital buckets is helpful.
That's well said. I think, and I think this question in particular is actually a little bit more focused on the sell decision. It sounds like as I reread it, it's kind of asking the question of, in an asset that tends to go up over time, why would I ever do any short-term trading? Why don't I just basically hold it forever and reap the returns and not have to pay taxes? But, I think that's a totally fine strategy for some or for some parts of the portfolio, while, especially in areas like we do with stocks, there's so many opportunities, beyond like what the broad indices are doing that, we try to really increase our potential for returns by finding stuff in those short and medium term time frames as well.
Yeah, I guess I'll point out maybe a weakness or two in this assumption, because he says something like, assets that go up and down, but ultimately always go up. Well, that's an assumption. Like, what asset are we talking about? Stocks, I think we can assume, are going to go up in nominal dollar denominated prices over time, because that companies grow and profits grow and we have inflation, right? And you want to beat inflation. Bitcoin may or may not always go up over time. Gold may or may not. Oil, any commodity, may or may not always go up compared to the price of a dollar over time, right?
Yeah.
So that's something that we have to address. The other thing is, I don't want to sell because of that. Well, okay, but can you stomach the drawdown, right? Like, in hindsight, looking at the last decade of Bitcoin, anybody that got into Bitcoin in the past, say, 5 years, it's easy for them to look at the historical chart and go, oh yeah, I would have held through that. I would have held, I could have bought more there. Hindsight's 2020. It's easy as hell to look at a chart and go, oh yeah, of course you should have bought there. Of course you should have sold there. But the reality is, in real time, when you look at that, what we call the hard right edge, where the price action hasn't plotted yet, that uncertainty, you're trying to make the best decisions you can with incomplete information in an uncertain future, right? So hindsight's 2020, and knowing that, you're always going to buy and sell at the right moments, it's impossible to know.
Yeah.
Right.
I think also too, when you have, when you're putting more income or more capital into your portfolios over time, you sort of have to make buy-sell decisions. You're not just going to hodl. And like you said, there's also a component of risk management where, there's something to be said for having diversification among asset classes and positions and things like that. So even if you're more of a longer-term hodler and you have a specific thesis on a certain asset class, there's still probably quite a few buy-sell decisions being made within that. And so I tend to, again, just kind of go back to the general idea that, take advantage of extremes in sentiment and market cycles. It tends to work out really well if you have a long enough time horizon. Even if you're more of a hodler overall, there's still opportunities to add capital at the right times and really, compound that wealth.
Yep, makes sense. Next question, Max was asking how to mentally recover from a big loss. This is a good one. I think a lot of people have gotten humbled over the last few months, both in crypto and stocks. As if you get in a position and you're up a bunch and then it craters back down to your entry point or lower, or you get in and it goes against you right away. How do you guys mentally recover from a big loss?
I do a lot of journaling. I will journal out, what led me to the trade, what I did wrong, what happened, just kind of outline everything and get clarity step by step. And journaling is helpful, but the other thing that I'll do is getting back into the market, and I'm going to speak from a trading perspective, more so than an investing perspective. But even though this can happen in investing, I think that once we have that big loss, our ego gets bruised, first of all, you got to put the ego to the side. You're not always going to be right in this game, period. Like, it's just the way it is. You can have the best thesis and the best research and the best everything and still be flat out wrong.
Hell yeah.
And you have to understand that. That's part of it. But once that happens and your ego is bruised, getting back into it can be very difficult because you don't want to lose that same amount of money or whatever it is. So what I'll do is I'll slowly get back in and I'll position size smaller to build back my confidence. So, okay, had a big loss, did all the things, ready to get back to it. My first trade back is definitely going to be size smaller. I'm not going guns blazing into this thing and risking losing another, X amount or
You mean you're not going to try to make your money back immediately on the very next trade?
Not. If you do that, you will continue to be bruised and broken down, and you will never get back to the right mindset. So I think slowly dipping the toe, grow as you grow your confidence. That trade works out. You stuck to your plan, even if it was a loss. You took your stop loss and you didn't, move it around, and you got out.
Yeah.
Then the next one, okay, your confidence is a little better. Then you move up on size, and you continue to do that until you've sized back in to your normal position size. That's how I do it.
Cool. Trav?
Hard to really add anything to that. I thought that was pretty perfect, honestly. But maybe one other thing that I might add is that for me personally, when I take a big loss, I definitely go back and look at the inputs, like not what happened as far as the output, what happened with the trade or the investment, the inputs. What work did I do? Did I do enough work? Could I have avoided this? How could I do it differently on the next trade? And that helps me to refocus, and honestly just helps me to be more motivated in doing my research and my work on the next investment. So I try to just kind of double down on my inputs and my effort and figure out how can I do better? How can I improve my process for the next investment? That's how I try to, mentally refocus and focus on the inputs rather than the outputs. But
yeah, I think another
Makes
thing
sense.
that really helps, especially on the stock side, is that there's always going to be another opportunity. I've been doing this now, over a decade. You've been doing this longer than I have, and I can tell you that there's always another opportunity that's going to come along. I mean, just look at Facebook, right? Facebook's down a ton for being so large, and this is setting up to potentially be an opportunity. A bunch of other stocks, there's always going to be something that happens in the markets that causes something that you can maybe pounce on. So that's something that I think helps too, is knowing that this sucked, this didn't work out for me, but I might be able to, do this again, or like my opportunity with Square, buying Square at $9 a share. Like, these opportunities will come over and over again. And you have to be patient. You can't just try everything just to get your money back. You have to wait, and you have to make sure it's right. And that's, I think, my best advice for that.
This happens with professionals too, by the way. Like a great example, Bill Ackman. He had a horrible loss with both Herbalife on the short side and with his investment in Valiant, which almost blew up completely. And it almost cost him his fund, his whole reputation. This was, basically 6-7 years ago now, where those two trades clustered together and almost cost him his whole career. And then, you look at what he's done over the past 2 or 3 years, has had some amazing COVID hedge trades with, making several $1 billion on the credit hedges. He did incredibly well with the turnaround at Chipotle. He's, doing some interesting stuff on the SPAC side, and now the world seems to, love Bill Ackman again. And so he's come back with not only his returns, but his reputation. And so this happens not just with your individual investor, but also sometimes even the best of the best, professional investors.
Yeah, I think it's important to keep in mind that trading and investing is a performance activity. It's a skill-based mental game of gymnastics. It's like you can, just like a baseball player or a golfer can be excellent at their craft and completely shit the bed, as we say. Like, you can go through periods where your performance is high and your performance is low. And I think, to your point, Nick, always remembering that there's going to be another opportunity can help you stay optimistic in the face of like, wow, what the hell just happened, right?
Yeah.
And also just, I always ask myself after a big loss, did I stick to my plan? And like, if not, why not? What happened? Because it's hard to have quote unquote big losses if you're thinking about risk management and you're going in with a plan. If you have a big loss, or if I experience a big loss, it's usually something happened that was outside of my control that I mitigated as best as possible. But it's very rare that I just wake up and I'm like, oh man, I just had a massive loss and I have no idea why.
Unexpectedly. Yeah. No, that is such a good point, because that's what we do, right? We go into something, we plan out the trade, we plan out how much we can lose on it, how to size it, what happens if XYZ happens, and we know in our portfolio every day, there's nothing that's going to take us out because we've properly managed our risk. Such a key point here, I think. There's no unexpected, oh my God, I'm done for. You know who this happens to? I just read an article in the Wall Street Journal. A guy, they featured this guy. I hate how they feature these freaking people. It drives me freaking mad. I'm like, of all the people you could be featuring, you feature a guy that put 80% of his net worth in GameStop, and it's like, that guy's going to lose his butt and he's not going to have any capital to ever trade again or whatever, or it's going to take him a long time to recover from that. But a good investor does not do that. And the crypto investors worry me a little bit, because I know you guys, you like to do that. You like to put all your money in one coin or, whatever it is, or one NFTs, or
leverage it 10x.
Yeah,
50x.
And it's like, that's where you're going to have that huge unexpected loss and you weren't thinking about risk management.
Yeah.
Sorry, I'll get off my soapbox, but that really riles me up.
No, it's true. I mean, a lot of people in crypto don't understand portfolio management and how to like allocate sizes and stuff. And that's why we talk about it so much. It's not the sexiest thing to talk about and there's certainly not any of these like new crypto YouTubers that know fuck all about position sizing. Excuse my French. I mean, it's just terrible seeing people talk about the next YOLO 1000x trade, bro. Like, that shit will get you wiped out. That'll break rule number 1, like we talked about last week. Don't do anything to permanently take you out of the game.
Yeah.
Right.
Yeah, I mean, quick plug, we spend more than a week on portfolio management and position sizing in the stock boot camp that I teach, and hopefully we'll have one of those opening up here in the next month or two. But, I've spent, I don't know, probably 200 hours thinking about running models for different position sizing frameworks and portfolio management theory. Actually, probably more than that, honestly, probably somewhere closer to like, I don't know, 300, 400, 500 hours on this topic. And there's still more to learn. There's still more to think about. But, position sizing is so key. And you're going to hear about those people that YOLO, they're levered 3x investment into YOLO Tesla calls or GameStop calls or whatever, and they totally crush it. What you don't hear about is the other 90% that get wiped out.
Yeah.
And
there's more of them, trust me.
Yeah.
There's more of them than the winners.
Yep. Yeah, I think those are all great points. Next question is, how do you not check crypto prices every 5 minutes? So I'm guilty of this. Like, I wake up and I try to not check prices for the first couple hours of the day, but sometimes I just do it. And
that's the first thing that I do in the morning is check the market.
Yeah. I mean, it's okay, I guess, if it doesn't throw off your routine, but I know what it feels like to obsessively check prices. What you can do, I think this is a very easy fix, is you just set alerts on price and you say, I only want to know if price goes above or below this level, and zoom out. Like, get off of the damn 5-minute chart or even the hourly chart. Like, look at the key daily zones and say, what would it have to happen for me to actually take action? And then set alerts close to those price levels and then forget about it. And you can walk away and just know, unless I get an alert, price is probably just chopping around in there and I don't have to obsess over it.
Yeah.
So that's a pretty
advice.
easy one. Yeah. All right. Next question is, Matthew was asking, in a previous show, we're talking about interest rates now. Previous show, you said you can't see rates above 2 or 3%, but some macro guys say that the end of the bond market decides how high rates will go and not the Fed. Can you guys explain how these dynamics work? Basically like the Fed versus, Trav, you were talking about this earlier, interest rates. You want to do like a very quick explanation of that?
Yeah, I think if you had asked this question 2 decades ago, the answer might be different. The answer might be that, the bond vigilantes, the bond market, actually has a big say in economic policy and Fed policy. That has very much flipped in the past decade or two for a couple of reasons. One, the Fed has become a bigger participant in the bond market through QE, right? Through buying Treasury bonds themselves, becoming a big buyer in bond markets, intervening in markets. The Fed plays a very big role. So I would say, no one else is going to bully the Fed around. I mean, the Fed, at the end of the day, if they want to, they could buy the entire Treasury market. So if they really wanted to do curve control and keep rates under a certain level, they can achieve that. Now, whether or not they want to do that is a different story. There's some political headwinds to, going completely crazy in an environment where we have high inflation. You're not going to see them buying all the debt up. But we said that, we didn't think, I think Nikki and I both said we didn't particularly see 5-year or 10-year bond yields in the U.S. going above 3%.
3%.
Yeah, probably not more than 3% by the end of this year. On a longer term time frame, who knows? But in this current cycle, hard to imagine that for a couple of reasons. One, the real impact that you have on businesses, cost of borrowing, the overall economy, and also on government finances. Government debt levels above 30 trillion in the U.S. now. A lot of the debt is now short term in terms of the composition of the federal debt. So it's going to be hard for the federal government from a budget perspective to stomach high rates. So if the bond market starts to sell bonds off because of whatever reason, pension funds start selling them in crisis or whatever, you will see the Fed step back in
And buy
and stabilize the market. So
it's maybe a mix between the Fed and the free market. If you will.
That's exactly right.
And you can't help but wonder, who corroborates together now that it will impact government, interest, essentially, if they raise rates too much, like you said. And I can't help but wonder what that dynamic is going to be like going forward. The government doesn't want the Fed to hike rates too much because that's going to cause a big issue with the debt.
Yeah.
Right?
Yeah, and it costs real problems in corporate credit markets at above a certain level. Again, I don't think 2 to 3% on a 10-year on the government 10-year, which means probably 4 to 5% on investment grade bonds is. I think that's a perfectly reasonable level to be at for where we are in terms of corporate financial health. But if it were to spike up and double beyond that, I think that would start to cause severe distress in financial markets and also eventually feed through into the actual economy itself,
Right.
like we saw in like the 08-09 crisis, for instance.
And I don't think the Fed wants that.
No. So, yeah, there's a balance here. And I will say the Fed is in a bit of a tight position because if you have ag commodities and oil continue to rise because of structural supply problems, that puts, that inflationary pressure on. And if we're still at 6, 7, 8% CPI a year from now, 2 years from now, even with rates at 2 or 3%, that's a tough position for the Fed to be in because they're not going to be able to raise rates to the level of inflation, but they can't necessarily put rates if the economy weakens. They can't because of the inflation. They can't
lower.
Yeah, they can't
back
lower
to
them.
zero.
Right? So that stagflation environment is what some people are worried about, and the Fed being between a rock and a hard place. But let's see how it plays out. I think there are some concerns there, but I would be very, very shocked to see a year or two from now rates above 3-4% on the 10-year.
Yeah, it's really interesting looking at the long-term 10-year yield chart, going back to the 80s where, rates fell from the mid-teens, and we've basically, since the mid-80s, been in an extended bear trend as far as rates go. And we're basically at 2% on the 10-year now, and really, we were at 3% back in late 2018, so it wasn't that long ago. What I think will be really interesting is if something happens that causes this downtrend to shift and we actually get above 3 and we see basically a trend reversal there, that would be obviously a major, major deal. I don't know.
Yeah. And I think you could see in that case, in the short run, some panic in the bond market and maybe some more forced selling, which would send yields up quickly. I think that's kind of what we've seen in European debt markets over the past 2 weeks is we had all these negative yielding, debt. Then the ECB started to get a little bit more hawkish, start talking about raising rates. And some of the bond market participants kind of freaked out, sold their bonds. Rates rose like, I don't know, I think it was like 50 to 100 basis points in some markets in a matter of weeks, which is a very quick rise. And so in the short run, you break those trends and you could see some panic in the bond market in the short run. But ultimately, why are we in this long-term, I guess you could say bull
Downtrend.
market in bonds and downtrend bear market in actual rates? Because again, bond prices move inversely to yields. But you've had declining yields for multiple decades now. And, a lot of the economists point to demographic headwinds in developed markets with population growth slowing in developed markets, technology obviously reducing the cost of certain products. You've got, just a number of kind of longer term headwinds for inflation. But, those things are long-term time frames, and in any shorter-term time frames, you could absolutely break out of that range, I think. So it's not impossible. I don't think we're saying it's impossible for 10-year rates to go above 3, but I think there will be a reaction function from the central banks if you see that happen too quickly.
Agreed.
Well said. All right, next question. We kind of answered the first part of this already, but Raz was saying, how do you manage your portfolio in times of market uncertainty? We definitely answered that. But the second part is interesting. Also, do you make any adjustments to your portfolio before you go on vacation or when you'll be taking a break from the markets for a while? I think that's a really good one. That's a logistical, like real life question.
Yeah.
Hey, what do you do when you're not going to be watching the markets all the time?
I will cut swings or shorter term positions if I know I won't be able to watch them.
Yeah.
I'll definitely do that. If I'm like, the reward isn't worth it, like whatever, I don't want to think about it. I've done that before. But I think it just kind of depends on the trade.
Yeah, for me, it depends on where price is relative to my entry point, right? So if I'm in a swing trade, say it's going to be a 2-week to 2-month trade, and I'm about to go on a 5 to 7 day hike in the wilderness, I'm not going to have internet. If price is really close to my entry level, then I'll cut it off and just say, okay, I'm flat, I'm out of this. But if I'm up 50% or 100% or more, and I'm like, okay, the trend's intact, the probabilities of this coming all the way back in that time period are very low, then maybe I'll leave it open. But obviously I won't put any new positions on right before disconnecting from the markets.
I may, depending on the time frame. Like, it's all about the time frame here, I think.
True. So if it's like a multi-year trade, you'll say it doesn't really matter anyway.
Yeah.
Trav, you don't go on vacation, right? You are always watching the markets every single day.
Hopefully that's not true. But yeah,
Just
I mean,
kidding.
I think similar to you all, like certain positions, like if I have options that I know are going to be expiring potentially while I'm going to be away, obviously we're still connected even on most vacations, but occasionally, once in a while, once in a while, there's something where I'll be truly disconnected for a week or two. And in those cases, I just want to make sure that I don't have any expiring options positions. You don't want to like go away and all of a sudden discover that you got, exercised on an options position and you own 10 times the amount of stock you thought you would. That's a scary, or even be short 10 times the amount you thought you were. That's a very scary position to be in. So I'll close out any options that are close to expiration. Anything short term, I'll try to either hedge or get out of. Otherwise, I don't really make too many major changes.
Cool. All right, next question. How to take profits in highly volatile markets, maybe selling for a small profit even if the asset is highly undervalued. Yeah, I mean, it depends on the market conditions in that asset class, right? Like if Bitcoin's choppy, which is the DJ, right? It's the DJ that determines how long the party goes on, and Bitcoin's chopping around, I'm not going to be really aggressive with moonshot profit targets on altcoins. But if Bitcoin's in a highly volatile bull trend, then I'm going to give those altcoins even larger percentage profit targets than Bitcoin because they move bigger on the upside and bigger on the downside. I don't know. You guys have anything to add?
I guess this is, depending on if it's crypto or stocks, but like in stocks, the key thing there is the fundamentals, and for me, the fundamentals and the technicals are guiding me, right? So it's like if I'm in a highly volatile market like 2020, 2021, and I was trading that, it depends on how fast things go. that's kind of where like and that can work on the technical and fundamental side. Like, okay, how's valuation looking? How fast did this go? How these candlesticks looking, you know, on the price chart? I think that kind of guides me on the stock side. But also, like, for example, he said maybe selling for a small profit, even if the asset is highly undervalued. Well, if it's undervalued and I believe in the thesis here and it's a good deal, I'm probably not selling that, right? You don't always have to be making moves on your positions. And I think it's probably different in crypto than in stocks. But for me, it's definitely, it has a lot to do with combining the technicals and the fundamentals and how far, how fast have things gone, how undervalued are we? And that guides my usually scaling out of, you know, my positions and taking profits along the way.
Yeah, because valuations are, dare I say, easier in stocks, right? Because you're valuing profits,
They
right?
absolutely are
Yeah.
easier.
In
in
crypto,
stocks.
it's like, what's an NFT worth? What's a competing, you know, an ETH killer worth? What, you know, those things are just so subjective. And yeah, you could make some mental models for how to do it, but it's not really tied to profits that a company is creating. That's just so much easier, right?
Yeah.
So yeah, I mean, if you're in crypto and it's in a highly volatile market and you think something's undervalued, buckle up. You might have a deep drawdown. All right. What are your top recommendations for resources to measure current market sentiment in crypto specifically? I think this is a good one because market sentiment does drive so much of what the crypto markets do. For me, it's looking at crypto Twitter. I have a few lists saved of different aspects. Also looking at the mainstream news. Obviously we have a community and we have a lot of, you know, connections in the crypto space, and also just, you know, public interactions like in, last spring. So spring of 2021, when Bitcoin was up around 65K, we just started hearing all sorts of day-to-day bullshit of people talking about get rich quick stories in crypto. And I know when that starts to happen too much, things are overheated, everybody's bragging about their easy gains, the market's about to punish people. And it sure did that. It fell by 50% in a couple of weeks and scared the shit out of everybody, and then recovered, hit a new all-time high. So I think, you know, between crypto Twitter, mainstream media, our connections, and just day-to-day interaction.
It's more of an art than a science, right? Like
Oh, for
trying
sure.
to figure out sentiment. I know there's some measures of sentiment, consumer sentiment, and all of that, but
Whenever I just start overhearing people bragging in day-to-day life in an elevator or a restaurant or whatever, I'm like, okay, things are overheated. We need to punish these tourists.
You do look at some of the Glassnode fundamental metrics, and some of those are I think, fairly correlated to sentiment.
Yeah. There are some on-chain metrics that can kind of give you a sense of what sentiment is, but there's no shortcut for people's behavior. I think that's just the biggest thing. And wherever you can get a sense of people's behavior and what their mental attitude is in that moment, you know, like going back to January 2015, when Bitcoin prices fell from like $1,000 to my buys were 188, right? That 3-day slide from like 250 to below 200 was such a depressing moment for the markets, and everybody was rage quitting. Whenever I see people rage quitting on Twitter, that's when I know, oh, okay, we might be close. When people are like, I can't take the pain, I'm packing it up, Bitcoin's a scam, fucking out of here, right? When I start to see that a whole lot, that's when I'm like, okay, we might be close to a bottom.
In stocks, there's a great historical study of there's a couple of different sentiment measures like the AAII, which I think is like an institutional investor. It's basically a sentiment gauge where they go out and they survey people and they do like percentage bearish versus bullish. And what's interesting is there's some academics that did a study that showed that the best forward returns in stocks tend to come when sentiment is actually highly negative. So when it gets to extreme levels of negativity, like when it's 90% plus bearish sentiment on the AAII gauge, the forward returns from that point tend to be the highest of any returns, like in any like quartile or however they look at it, whatever time periods they look at. In that, I mean, that
makes sense. Yeah. There's the fear greed indicator in Bitcoin as well. And you can map or kind of overlay that on Bitcoin's price, where when fear hits the highest levels, it's typically at capitulation points, which from a risk reward standpoint, that's where the biggest upside is. So yeah, probably really similar.
Amazing to see it, right? Because you always hear that, and we even say it ourselves, like, you know, when most people get bearish is the time to get, you know, bullish, and vice versa. And it actually is shown in the real world data, at least in stocks.
But it's easier said than done.
Yep.
Oh, for sure.
And it takes practice, for sure.
Yeah.
Definitely.
Yeah, buying in March of 2020 or, you know, February, March of 2009, there were not very many people who were going to do that or able to do that.
Yep. All right, let's hit some news things that we wanted to bring up. Nikki, I thought this was pretty interesting. I think you dropped this in the document. IRS court settlement doesn't clarify crypto staking taxes. What's happening right now in crypto tax land?
This is a big story right now because crypto mining, you know, that there's mining and staking. And crypto mining, the IRS has made it very clear that if you mine and you have your crypto that you get from mining, you pay taxes on that crypto that you receive as a reward, quote unquote reward. Is that what you call it, right? When you're mining?
Yeah.
Sure. So the IRS has made it that very clear. Rewards are going to be income, pay taxes on them right away. Now, this staking case, there was I guess a couple that went after trying to get a tax refund for their staking rewards that they paid as income, right? Because we're assuming the same principle as mining with staking. Okay, if you got to pay income on mining rewards, you got to pay income on staking rewards when you receive them. Well, apparently they won, and the IRS gave them a tax refund. Their argument was, we should not have to pay taxes on the staking rewards until we sell the rewards. They won, they got the refund, and this is now a huge controversy because now the whole crypto community is like, yes, mining and staking rewards, we don't have to pay any taxes on them until we sell the rewards, but not so fast because we still do not have a precedent on this. The IRS has not issued formal guidance on this. The person that is that received the tax refund, they're requesting for the IRS to say yes or no. What is it? Like, what are we doing here? Because now the miners have the IRS guidance. The miners know what the IRS is saying, but the miners are probably thinking, oh, well, if this happened, we're just not going to pay taxes until we sell. So it's kind of causing this whole big, like, I don't know, issue. And we're going to probably see a lot of people try to sneak past the IRS, and miners are going to try to not pay taxes on their income. They're going to wait until they sell their coins and all of this. But it's to be determined. And I encourage everybody to understand that with the staking rewards, even though we have this case that you could argue, you know, if you get audited, you could argue, hey, we had this case and staking rewards are not being taxed until they're sold. That doesn't necessarily mean that the IRS is actually going to accept that. So I think that until we get the IRS coming out and saying, here's what you do with staking rewards, we can't assume anything. It's very tricky.
Don't you love crypto taxes? Oh my God.
It's so funny though. It's so like contradicting.
Yeah.
And you can't help but wonder like how this stuff happens. Like how I know that like crypto is new and there's a lot to unpack here, and you know the IRS probably doesn't even know half. I'm sure they've got some smart people that can help them figure it out. But I mean, the government and the IRS, they're not quick to being up to speed on this stuff. They may not realize that like staking rewards are, I mean, isn't it kind of the same thing, a staking reward versus a mining reward? How are they different is my question.
Yeah. I mean, mining rewards are very much different than staking rewards in a certain sense. So I can see where the confusion comes in.
Okay.
I don't know. Crypto taxes, I feel like, are still way more complicated than they should be. I saw a funny I think I got retargeted like a YouTube ad or something. I think it was like H&R Block or one of the big ones. It showed this guy. It said, he's like looking at his computer and he goes, I'm a millionaire. I'm not a millionaire. I'm a millionaire. I'm not a millionaire. And then it said, need help with crypto taxes? Like basically, because it's so confusing when you have multiple exchanges. If you're a miner, you have mining rewards. If you're staking, if you're doing DeFi, if you're doing NFTs, like this is a nightmare.
Yeah.
Like it is bad, and
it's pretty bad because we don't know, because the IRS hasn't told us.
Yeah.
The only thing we know is that mining rewards are taxed as income. We know that if you buy a Bitcoin and you sell a Bitcoin, you have capital gains. You may have income and you may have capital gains to deal with, depending on what you're doing. If you're mining, and it's crazy.
Yeah.
So I just, there are going to be a lot of cases like this that come out. People are going to try to push the limits, and people are going to become what sets precedent for this. People that get audited and things like that. So
TBD.
TBD. Yeah, very much so.
All right, Nick, I know you have, should I call it a prediction?
Yeah.
Okay. We were talking about this, and I wanted to make sure we got to this. So there's a reason why we have Amazon and Pinterest, why we're comparing their market caps. Amazon's currently 1.6 trillion. Pinterest is worth 17 billion. What do you think is going to happen?
So I came to the conclusion this week. I have a prediction that I think Amazon will try to buy Pinterest. I could be completely wrong. This is completely just like a hunch based on some information, nothing that I received, just by looking at the two companies and making certain, assumptions.
Mm-hmm.
And it's funny because there was some talk that Amazon was going to go for Peloton. I think Pinterest makes way more sense for them, and I'm going to tell you why. So Pinterest is an app that is it's a pretty hated stock right now. But what they're doing is they're trying to transform from like an image, an app where you go and you look at pictures, right? And they're transforming that into basically a video shopping app where they're doing, what do you call it? QVC like videos, and they're really trying to integrate shopping into the app heavily. And it's not going to be known as much of a social app as it is a shopping app, and it's going to have that social element. Well, I was on Amazon the other day, and I didn't realize that they had integrated a similar idea into Amazon. Like you can actually go on Amazon through the app, and there's a way you can explore styles, because Amazon's trying to move into fashion. I think it's an epic, I don't see how that really goes very well, but we'll see. But they have a similar type of, integration where you can click on a picture and it pops up, an Amazon product, right? And so they are basically trying to duplicate the many features of Pinterest within the Amazon app with fashion and shopping already. But you don't really think to go to Amazon to search images to find things to buy, inspiration and things to buy. And the other thing that I'm noticing is on Pinterest, they've implemented a TikTok TikTok-like feature where it's videos and you can scroll the videos. And it's a lot of Amazon videos. It's like 10 things under $10 to buy on Amazon. And it's like one after the other Amazon videos. And I'm thinking, are they like trying to test this or something? Like, are they trying to test if Amazon videos, like creators making those types of videos, if you click on it, like, will people actually buy things on Amazon? I don't know. It's just a hunch, but I'm almost thinking that it's a perfect match. Why wouldn't Amazon want Pinterest's over 400 million user base to integrate versus whatever they're trying to do that nobody knows about and nobody cares about? No one's really, I've never heard of searching for clothes through Amazon versus this photo, via this photo feature.
Can I say a couple things on this?
Yeah, go ahead.
Okay. Because I actually think the more I thought about this, when you mentioned it, sort of a light bulb sort of went off in my head, because I think this combination would make an absolutely like no-brainer for both of these companies. And so I think actually there's maybe a pretty good possibility. I don't know on what time frame. Maybe this takes 2 years.
Who knows?
Maybe Pinterest needs to like prove out some stuff. Maybe Pinterest even decides that the opportunity is big enough and they can capitalize it themselves and they just stay independent. But what is a couple things that are interesting to me with this, you know, Pinterest was reported to be in play as an acquisition target by both, I think, Microsoft and PayPal at much, much higher prices just a couple of months ago. So like I think last fall it came out that PayPal was poking around. Microsoft had also poked around. Price range 60 to $80, let's say. So well above where we trade today, by the way. Pinterest, when you look at their multiples, valuation multiples, looks very, very reasonable at today's prices. I don't think they would sell without a massive premium to the current price, even though they're, you know, having some challenges in the short run. But in Asia, you see massive, massive business being built in live commerce and in streaming commerce, where you have these influencers who are selling products, you know, in some cases, millions of dollars of products on, you know, a 30-minute stream. And so it is believed that we will see the same thing happen in the US, where we'll see live streaming commerce become a much, much bigger deal. And there are platforms like YouTube and Twitch that are trying to position themselves. By the way, who owns Twitch? Amazon owns Twitch. Amazon bought Twitch a few years back. Yep. Twitch is a great asset for them. One of the ways I think they'll be able to expand Twitch is through live commerce. And Amazon also happens to be, you know, one of the most trafficked sites on the world to actually go and buy products. They've got your payment info already, right? So if you bring over the, you know, creator side and the creative side of Pinterest, and you could mesh it together with both the streaming platform Twitch and the platform where people buy products, I think there's actually something very, very compelling in that combination. So yeah, this is an idea that I think, you know, we're not saying go out and buy Pinterest here because it's gonna happen, but I think
we never know.
Yeah, but I do think it's an interesting possible combination that just makes too much sense, and you're not paying a whole lot for that optionality here at current prices.
And Amazon can afford it.
Oh, yeah. Absolutely. Yeah, they've got the capital.
I mean,
they could use just a tiny amount of stock to do it. You know, it's a.
I guess the only thing is antitrust, maybe, but
yeah,
I don't know. We'll see. But you heard it here first. If it happens, I'll look like a genius. But
okay, so I know you traded this during the pandemic. Are you still holding any Pinterest?
Yeah, so I bought some pre-pandemic and during pandemic, and then wrote it up, took some profit at the top, and now I've been scaling into a position, adding to my, because I still had some from when the March 2020 panic happened. I still had some shares there left. So I've been adding to that and kind of
lowering your cost basis.
Lowering my cost basis, working into this position again. Because, you know, look, Pinterest has its issues, but remember, they are a cash flowing business.
Yeah.
They are growing average revenue per user still, even with struggling user growth. I mean, there's a lot to like here. There's a lot of potential in where they're heading. But it's a big transformation. But I do think something like Amazon, after I saw that feature in Amazon, my spidey senses went off and I was like, integrate Pinterest, boom, done. Right? Like, and then like they're doing search by photo, like you can take a photo and, you know, search it. They're doing a lot of the same things, but you don't think to go to Amazon to do these things. You think to go to Pinterest to do these things. You need a new table for your house. You need a new shirt. You need a new, you know, eyeliner, whatever. That's where you go to get the inspiration. And I think that it's just there's a lot of things to like about those two combining.
Well, we'll keep an eye out for it.
Yeah.
Awesome.
I could be completely wrong. I don't know.
Well, it's an early thesis, right? And hey, to play devil's advocate, maybe this is, you know, confirmation bias where you're long the stock and you're looking for reasons why it could pop, and you're like, oh totally. Amazon should buy it. I don't know, but I mean, it does make sense what you're saying, and Trav, you made some good points too. All right, well, I'm gonna go leverage long pins right now. All right, well,
you want to leverage long Pinterest, not Amazon.
Right. Okay. Well, look, we've been going for almost an hour and a half, I think.
Yes, we have.
Yeah, good stuff. A lot of good questions. You know, I guess to recap, markets are kind of in 50-50 chop areas, at least on crypto, and stocks are at decision points as well. Anything you guys are looking forward to over the next week? Obviously, we have inflation data in a day or two.
Yeah, the inflation print will be pretty big. We still got lots of companies reporting earnings over the next couple of weeks that we're going to be tuned into. So lots of big moves up and down.
A lot of things we own still haven't reported. So, yay, get ready for the adventure.
Cool. All right, well, buckle up, guys. We got probably a volatile week or two or more ahead of us. So thanks for watching or listening to the show. Go to wetalkmoney.com, submit a question for the show. Also, feel free to check out our wealth building community at wetalkmoney.com/community. And we will see you guys next week. Thanks for joining us, and see you then. Take care.